You're about to hear something few are ready for. The next great financial reset is not coming. It's already underway. And the biggest battleground? Between the world's largest economy and its challenger, the United States versus China. What if I told you that a $37 trillion structural shift is looming, and that your portfolio, your job, your future could be reshaped by it? Let's dive in. Think of the global economy as an enormous bridge. For decades, one side, let's call it West, built the road up to that bridge, and the other side, East, built the road down. Goods flowed, capital crossed, jobs shifted, the structure stood, and the Americans and Chinese both benefited, albeit in very different ways. But now the bridge is creaking. Why? Because underneath it all is a massive imbalance. The U.S. relies on Chinese manufacturing, cheap goods, abundant labor, enormous scale. China relies on U.S. demand and technology, the export engine, the access to advanced markets. It's a symbiosis, but also a time bomb. When either side senses they're losing the game, they apply the brakes, and that's exactly what we're seeing. Here's one hard fact. China holds dominance over rare earth minerals and processing, the critical inputs for everything from smartphones and EVs to advanced weapons systems. In their analysis, China controls about 70% of rare earth mining and around 90% of processing. That gives Beijing enormous leverage. Imagine holding the only key to a door that everybody else needs. And now they're saying, we're going to change the rules. In April 2025, Beijing introduced export restrictions on 7 medium and heavy rare earth elements: samarium, gadolinium, terbium, dysprosium, etc. In short, the materials that underpin clean energy, electronics, and defense are suddenly part of a geopolitical chess game. On the U.S. side, the response is dramatic. Massive tariffs, import controls, export restrictions on sensitive software and chips, the tools of economic warfare, the stakes, trillions of dollars in trade, disruption of global supply chains, the future of manufacturing and tech leadership. So you might ask, why call this a $37 trillion reset? Because when you add up the U.S. economy, approximately $25 to $30 trillion, China's approximately $18 to $20 trillion, and then account for global knock-on effects, trade flows, capital shifts, manufacturing relocation, supply chain redesign, we are looking at a once-in-a-generation structural change of enormous size. And the bridge analogy? The bridge isn't just creaking, it might be rebuilding or being rerouted. Here's where you need to pay attention. 1. This isn't just about tariffs or trade war drama. It's about the foundation of how global business has operated for decades. 2. When foundational rules change, markets don't always react immediately. They often overshoot. They often misprice risk. That's where opportunity lies and where danger lurks. Let's walk through how this reset is unfolding. First, trade imbalance. The U.S. has run large deficits with China for years. China has built export-led growth. U.S. consumers have fed it. That model worked until it didn't. When Beijing felt threatened by technology embargoes and heavy tariffs, it pressed back. The deadline for the trade war to stay just business has passed. Second, supply chain shift. It's no longer just make in China, ship to U.S. The risks of over-reliance are now obvious. One disruption, one policy move, one export ban, and the ripple runs through the world. Analysts note that high-tech industries in the U.S. are vulnerable because they depend on Chinese-origin rare earths and magnets. So companies are now asking, should we locate manufacturing elsewhere? Should we hold more inventory? Should we redesign products to use alternate materials? All of that takes time and money. Third, market reaction. Easy money, cheap capital, global supply chains. These supported a huge bull market in the West. But when the structural foundations shift, markets get uneasy. We've seen rallies. We've seen big divergences between sentiment and fundamentals. When a handful of tech firms dominate indices, you're risking concentration risk. When trade wars threaten inputs, you're risking supply chain disruption. Bottom line, the noise is louder, the risk is higher, the margin for error is smaller. Now, here's the human part you must not ignore. Markets may deal with data and charts, but we deal with emotions, fear, greed, uncertainty. When the world changes, so do schedules, so do lives. Jobs, business models, careers, all can be knocked off course. Remember, when routines break, discipline slips. It's hard to think long-term when you're reacting day to day. Simplifying life, reducing stress, holding to fundamentals becomes more important than ever, because when the bridge is being rebuilt, you want to sit in the driver's seat, not be the one scrambling when the car skids. Let's talk numbers. $37 trillion isn't a guess. It's a rough summation of the US and Chinese GDP, trade exposure, financial markets, corporate valuations, and global ripple effects. Think about it. Trillions in supply chains, trillions in equity markets, trillions in debt, all intertwined. When you alter one side of that equation, the other side shifts fast and unpredictably. Consider rare earths again. These aren't just metals, they're the backbone of EVs, wind turbines, advanced electronics, and defense systems. If China throttles exports, prices spike, production slows, US companies scramble. That's exactly the kind of disruption that can erase market gains overnight, even after one of the strongest 6-month rallies in history. And here's the thing about rallies: they feel safe. When only a handful of companies drive the market, it creates a false sense of security. Investors start thinking nothing can go wrong. But markets are rarely that obedient. Volatility clusters. The best days and the worst days often sit side by side. Miss the best days because you panicked during the worst, and long-term returns suffer dramatically. Now, some of you might be asking, should I just sell everything and wait this out? That's a temptation many fall for. Emotional stress spikes during sudden market drops. People overreact. Discipline slips. But history is clear. Those who stayed invested through fear, through previous crises, dot-com crash, 2008, COVID crash, ended up benefiting the most. Waiting for perfect conditions means missing opportunity. Let's break down the difference between investing and speculation. Investing is slow, steady, methodical. It's holding broad index funds, staying diversified, focusing on the long term. Speculation is fast, emotional, reactive. It's trading headlines, chasing hype, betting on the next sure thing. Overconfidence fuels it, and history shows speculation rarely wins consistently. Volatility is brutal but normal. Since the 1940s, there have been nearly 50 market pullbacks of 10% or more. Small declines happen regularly. The current market swings, they're within historical norms. It's the true bottoms, extreme pessimism, near panic, that mark the reset points. We aren't there yet, but the path is being paved. What does this mean practically? First, stay invested. You want exposure to both the highs and lows. The market's best days happen during periods of fear. Miss them, and your returns shrink. Second, maintain liquidity. Cash for opportunity allows you to capitalize on corrections without stress. Third, manage your life like your portfolio. Reduce daily friction, maintain routine, stay healthy. Emotional clarity translates directly into financial discipline. Let's focus on sectors. Tech, defense, and energy are on the front lines. AI may be hot, but overvaluation risk is real. EV supply chains, vulnerable to rare earth restrictions, defense contractors, exposed to export controls, global manufacturing, facing potential reshoring or diversification. Understanding sector risk isn't about predicting the next headline. It's about mapping where the bridge might break first. And here's a counterintuitive insight. The bigger the crisis narrative, the bigger the opportunity, if you're prepared. Markets hate uncertainty, but prepared investors thrive. Those who understand the structural shifts, who hold cash reserves, who stay disciplined, can turn global disruption into wealth. So how do you navigate this $37 trillion reset without losing your mind or your money? First, mindset. Markets are a marathon, not a sprint. Headlines will scream. Tweets will roil markets. News cycles will exaggerate fear. But your discipline is your moat. Emotional investors lose money. Calm, prepared investors thrive. Second, strategy. Stay invested. Diversify. Use broad index funds. Keep a portion of cash ready for opportunities. Avoid over-leveraging. Do not chase the hype of a single sector. Remember, concentration risk has destroyed fortunes before. It will again if ignored. The secret is consistency over excitement. Third, daily life matters. A steady routine, good health, clear priorities. These are not soft skills, they are financial tools. When stress spikes, cognitive bandwidth shrinks. Decisions made under panic are rarely optimal. Simplify your life, reduce friction, protect your clarity. That's how you stay rational when the markets test you. Fourth, opportunity is everywhere if you're ready. China's export limits may drive new investments in mining, clean energy, and domestic manufacturing. Tech restrictions open the door for American innovation. Supply chain disruption forces companies to rethink global logistics. The $37 trillion shift is scary, but it is also fertile ground for those who act thoughtfully. Now let's be brutally honest. The worst days may be ahead. But volatility is the cost of admission to long-term wealth. The market doesn't punish you for holding your ground. It punishes you for fleeing at the wrong moment. Historically, those who stick to fundamentals, weather short-term storms, and focus on compounding over decades always win. Here's the takeaway. You can't control geopolitics. You can't predict the exact day markets react, but you can control your behavior, your investment discipline, your financial education, your emotional resilience. Those are the levers that will determine whether you emerge ahead or fall behind. So what should you do right now? Review your portfolio. Ensure diversification. Hold cash for opportunity. Simplify your life. Strengthen your routines. Maintain focus. Ignore sensational headlines unless they align with your long-term plan. Prepare to navigate uncertainty without panic, because the $37 trillion reset isn't coming, it's here. And the bridge between the US and China is being rebuilt as we speak. Those who act strategically, calmly, and with discipline won't just survive, they'll thrive. If this analysis helped you see the markets in a new light, do this. Like this video, comment below with your thoughts on where the next opportunity might emerge, and subscribe for more insights. The world is shifting fast, and understanding these changes early can make the difference between watching wealth pass by and capturing it for yourself. Stay disciplined, stay informed, and cross the bridge with confidence.